The title of the session is about which mega market in Asia is a better long-term PE bet. So I've asked the panelists to kick off by doing two things. One, to talk about how India figures into their larger global strategies, so not just Asia, but their global private equity portfolio. But then also to do so in answering this question about what does a good long-term bet look like? And why is private equity a good long-term bet for these markets? So Vincent, why don't you kick off?
What is a long-term bet? I think China and India are both very large and growing economies. And we believe in the next 10, 20, even 30 years in India's case, we'll still see tremendous growth from both countries. And from macro perspective, I think both will be a very good long-term bet. However, as a private equity investment, we believe China offers a better investment opportunity. I'll give you some numbers because I've been covering China and India for quite a bit. I ask a lot of people, there are about 700,000 companies altogether, registered private companies in India. Let's say 30% of that are active. So you're talking about 100, 200,000 companies altogether. Of those companies, if you can contrast that to the number of companies listed, which is about 7, 8, 9,000 numbers are all different when people talk about, are you going to ask different people? So it's actually not that many companies you can select from. If you go to China, there are 43 million registered companies. Let's say 20%, 30% are active real businesses. You're talking about 10 million and above companies with which you can select from. At the same time, the banking system generally do not lend to the fast-growing small private companies. And also, you cannot go to public markets easily. There are about 2,300 companies altogether listed within China in the last 10 years. Last 20 years, sorry. So this gives private equity a tremendous room to play. On the one hand, you have a lot of companies to select from. On the other, the difficult access to capital markets and bank fundings give the PE manager the leverage to negotiate down the price. So, and if you look at the growth, both countries have been growing quite dramatically over the last 2-3 decades. So you have very good growth, and you have the room to arbitrage between the public and private. This is why the return from China has been very good. Now that's changing, given the competition coming up from the local fundings, etc. But that still give us a much deeper opportunity set than India offers today.
I wouldn't disagree with a lot of what Vincent just said. I mean, I think we have a very similar perspective on, I guess, historically where the opportunity has been. As a group, we invest in globally as well. I think that within the emerging market bucket, we're currently at around a pace of trying to get to around 40% annually towards commitments in that space. India is a very large component of that, or it's around 25% of that portion. So overall, we're at about a 10% of our portfolio annually goes towards India. Again, we don't necessarily target that number. It's just sort of where things seem to fall out. If we don't get there, it's no big deal. If we end up higher than that, it's also fine. I mean, I think the way that we also look at the EM bucket, maybe in terms of the long-term play, I think it's very clear that India and China are very long-term plays. There's a lot of short-term opportunities as well. I think perhaps more so on the ARB side, as you said, in China, there's been a lot more short-term opportunities, quicker flips, just a more developed exit environment, just because the IPO environment was such. The A-share market also allowed for that as well. The Indian dynamic is probably, by default, unfortunately, an even longer-term play, just because it's very hard to get liquidity. I think the exit information that was up in one of the earlier presentations was stunning in a negative way. So, I think that for us, we view it as a very interesting time to continue committing to India, particularly because of some of the charts you put up. And the fact that there's less excitement, that there's less capital going to the market. There's a lot of players who are not necessarily going to be there in the next go-round because it's no longer as easy as it appeared. So the people who are here and working towards kind of building something for the next 10 years are really looking at the next 10 years. And even just sort of the valuations that we see at certain segments of the market are extremely compelling. So again, as a category, it's been disappointing overall, but there are a lot of nuances to the market. I think some of the charts you have in Africa or Latin America are also very interesting because we do commit there as well for very particular reasons, not as developed as of a marketplace, but we can go into sort of valuation and dynamics that exist there.
In terms of what we've done in India for the last sort of, I guess, 9 to 10 years, we've been investing in India since 2003. Roughly 3 to 4% of our global allocation has been to India. Now, I will say it's sort of been cyclical as well. A lot of our allocation started back in 2003, went up 2004, 2005, and from 2006, sort of our allocation to India relative to our global allocation has slowed down. We see that trend probably reversing in the next sort of year or two. While we were committing to 2 to 3, maybe 4 managers a year, 5 years ago, we've been committing to 1 manager, maybe 2 managers a year over the last 4 to 5 years. And certainly, as compared to China, as compared to the rest of the world, from an emerging market perspective in particular, the percentage allocation to India has been lower. A couple of reasons for that. We have a relatively opportunistic outlook. We look at where we can create the best return for the risk. And frankly, the return that we've seen out of the United States, out of Western Europe, whether it's lower middle market buyout, whether it's distressed debt, we've seen the opportunity of that be quite exciting. So versus the capital going to China over India, it's more likely that the capital from our standpoint has gone to distressed debt, lower middle market opportunities in the Western world, the more developed markets per se. In terms of what makes a good long-term investment in private equity, it's fairly simple. It's about the return that you're going to get relative to the risk you're taking, also relative to other asset classes, and the outperformance from illiquidity and all the other challenges that private equity presents. And as we see the market in the near term, you can either make money in private equity on the buy, so you're buying in at a lower valuation to the public markets, to the secondary markets, etc., and you're making money because you're buying companies relatively cheap. We haven't seen that in India for the last sort of 4 to 5 years. I think there has been a lot of capital raised. I think entrepreneurs, business owners are fairly savvy about what they can do from a capital raising perspective. And most of the private equity funds we've seen have actually been buying not at valuations which will give them a return automatically. So that sort of automatic buy low, sell high, of the early 2000s, mid 2000s, that has certainly gone away. So then how does the private equity market here make money? It's on the hold. What do you do in the 3 to 5 years that you hold the company? How do you help grow it? How do you make sure at the time of exit you're actually getting that arbitrage? We've certainly seen some strategies, particularly in the smaller sector, particularly with niche strategies, sector-focused strategies where I think managers will make that money. So India continues to be interesting to us, although relative to where we are seeing value, it's lower than where it is before. But I agree with Manny. I think, being a contrarian, when most people walk away, there's probably going to be value over the next 2 to 3 years where, in fact, the opportunities will come back, and we might see in the next year or two the number of commitments we make to India certainly increase. I think there's a number of managers that are highly qualified over here. It really is the question of whether they can make money in the medium to long term.
And lots of interesting threads in your comments to pick up on for our next question. How do you think the overhang that you see in the Indian market will play into valuations, and is it still going to be this attractive kind of, as you say, a counter-cyclical play, come in when everybody else is running for the exits? Vincent, let me start with you on that.
I think India will never be a cheap market. That's the consensus I think generally from most of our GPs. Valuation now is at a reasonable level, and with the right GP and backing the right companies, basically your return is how the company grow, its profitability. So you're reasonably expecting a 30-40% IRR from best GPs in best companies. Arbitrage in India doesn't exist. I think it's the other way around. You probably have to pay a small premium for getting into the management position. In China, I think that situation has, the gap has been shrinking very quickly because there's a lot of capital chasing private deals these days. And there's also the talk from our new chairman of the CSRC that the market may open up in terms of approving the IPOs going through. That was only last week. So I think in both countries, what we always believed in all along, despite the good returns we are seeing in China, is that all the GPs have to focus on the operational improvements. That's the only way that you can ensure your returns.
On valuation, I think it's interesting. I mean, India is obviously expensive, as I think it's been said many times, and as Vincent just highlighted as well. But when you think about the types of valuations you see in other markets, right? So Latin America, as an example, there's a lot of funds that we look at now and that we have exposure to that consistently have been doing investments on a 5 times trailing EV/EBITDA investment with 1 or 2 turns of leverage as well. They're controlled transactions in moderate growth businesses. Fantastic, dynamics. They control the exit, and there's not as many managers, so it is a slightly different dynamic. But at the same time, it's great value versus 8 to 10 times forward EBITDA, or here in India or in some other markets too. So you obviously have to wait at least another 2 years until you grow into the same valuation. Then you have to obviously do a bunch of other things to kind of get to an exit. So just fundamentally, India is going to have a much longer hold period. So you kind of buy into that to a certain extent over the last 4 or 5 years for the general PE asset class, where maybe the return dynamic that exists here in that 15% IRR range for the mid-cap general PE segment is okay, given the dynamics and growth relative to what you would see in the mid to large cap space in the more developed markets. Places like Africa, same dynamic, but you're getting in like the number one business 4 or 5, 6 times EBITDA in a sector that's just completely greenfield with no competition. Completely different governance issues and transparency issues, but just there's much more compelling valuation outside of India on a pure number basis, right? So that's, I think, clear, and I think everybody understands that. I think when you go down to the more niche type strategies that I think a lot of people deploy, you actually do see some very compelling valuations. Maybe it's not an arbitrage between the public market and the private market, but there's still compelling valuations given where the growth is going to come. I think the dynamic that exists when you look at, just the PE dynamic here, because you have, the 6,000 public companies, right? So do you have to invest in PE to get exposure to certain segments in India? Absolutely not, because you can get it through the public markets, which is why I think a lot of people have sort of gone in that direction. But places like Africa or Peru or Colombia or Brazil, Indonesia, I mean, there's 400 public companies in probably each of these markets individually, and you can't get exposure to the non-cyclicals by doing public equity. So I mean, I think the case for PE here is very different, right? I mean, you have to sort of be much more focused on sort of it's a long-term play, long-term growth. You're hopefully working with managers who will add value, and it won't be just sort of the same story that has existed over the last 3 or 4 years. So it's I think just a very different mindset. So it fits into an overall portfolio, but not necessarily for the same reasons that you look at all the other markets.
Yeah, really quickly, I do agree, I think, on 2 of the points that have been covered earlier. I think Manny mentioned this, but I do believe that there's opportunity in terms of valuation at the small end of the market. The managers that we've invested in that are, I guess would be defined as micro-cap managers or smaller managers, sub 100 million in size, we continuously see them entering into companies primarily with first-time entrepreneurs that are willing to frankly give up a larger percentage of the company for a lower valuation to help them grow the company at valuations that are very interesting relative to the rest of the private equity market in India, relative to the public markets in India. Valuations are very interesting, but you're also taking that operational risk, that growth risk, so to speak. And we do find that part of the market pretty exciting and interesting. And then to Vincent's point, I think the only way that in India you're going to make money over the next 5 years, 10 years is where you can take a company, pay a reasonable price, whatever that be, whether it's a discount or a premium to public markets, but essentially help grow it or transform it, really add value over the next 5 years of holding it so that you can, hopefully exit at a nice multiple for the risk that investors are taking.
Which I think feeds in really nicely to the larger conversation we've been having at this conference about, manager selection. There was a panel earlier today that touched on cherry picking, and I think the panelists here have all commented on there's money to be made in certain pockets of the market. So looking at India relative to other Asian markets where you invest or other global markets where you're investing and thinking about your manager selection process, how do you find the winners? Are you looking for emerging managers perhaps who are maybe earlier in their stages of development and maybe a bit more hungry? Are you looking for guys who are maybe coming out, they're spun out of a larger team and therefore they have what you consider a pedigree? In terms of niche strategies, what kinds of plays do you think work particularly well for the Indian market versus niche strategies that might work well in the Chinese or other markets?
Sure, and again, going back to the comment that we are committing to maybe one, potentially two managers a year, even in the worst of markets where valuations are sort of crazy, we do think that there are managers that will make money by staying disciplined, by employing a strategy that works. So the bottom-up approach of looking at all the managers within India and then looking at those managers relative to what we are committing to in the rest of the world, whether that's emerging markets or it's developed markets, really that's what it boils down to from a diligence and selection perspective. It really needs to perform well in our portfolio, and I do think that there are managers out there in India that we can do that with. The manager selection process in India is, has its own challenges. There's been a lot of turnover, there's a lot of spin-outs. The alignment of interest hasn't necessarily been straightforward. I think the sponsored fund model is now broken within India, and that's sort of been a big change over the last probably 5 years. So, having said that, Ed made this comment maybe last year, there's a lot more managers in India to choose from, and given that you're probably likely to be able to find that one, it makes your job a lot harder, but you can find that one manager, two managers that will outperform relative to India and relative to the rest of the world, but it really is going to be a much higher bar for those managers to jump over, given what's happened in Indian private equity returns over the last 3 to 5 years, and given what's happened, frankly, from a transparency and a team perspective in the Indian private equity market over the last 3 to 5 years.
Indian market requires in those managers that you're choosing. Something else that's been touched on today is the need for more of an operator's mindset within the manager team. So to what extent is that factoring into your screening of Indian managers to invest with? Are you looking for guys that come from the sectors where they hope to invest or are staffing themselves with former CEOs from those industries? Manny?
Yeah, I think the operational value add is a big part of, I think, where all of us are focused. And I think all of us probably who have invested over the last 4 or 5 years in India have a pretty high overlap in the managers we selected because of the stage at which the PE market was here. So a lot of the more branded names that I think everybody was more familiar with, that people gravitated towards because they were in their second, third, or fourth fundraising, it just made sense. And timing-wise, it was obviously a very bad time to invest, just given what happened in the world and valuations, et cetera, and the amount of capital that came into the market. So I think a lot of those names have done a fantastic job of just sort of maintaining themselves, and also some of which have differentiated by specifically what you're saying and really focusing on slogging it out with the companies, with operational teams, and adding to platforms, et cetera. So I think those are the ones that I think going forward to us are sort of a select group of those are considered kind of core that we build around in the type of funds. They fall into the more traditional PE dynamic, and then we have around that more opportunistic plays that we commit to, because we find that there's either at least in our portfolio, the way that it's turned out is the more opportunistic plays that we've committed to have had substantially better returns than the traditional names. The traditional names aren't doing bad. It's just that there's a huge differential, different risk profile. But you just sort of need to make sure that you balance the two out, and that today's environment is such that there's a lot of various names, and the ability to sort of wait through the fundraising to see how the portfolio might develop, to kind of look at 1 or 2 deals that are in the new fund that you're looking at is a big part of what we're doing as well. So we might not necessarily think think that we're going to be with a certain fund manager in the beginning, and then by the end of their fundraise, we realize that, wow, they've really done a fantastic job creating, value in these one or two deals that are in the portfolio, and we feel comfortable that it's going to return, half the fund, if not more, or something. So, that's the way that we're looking at it here. It's a much more opportunistic approach because it's such a fragmented market because of how many players are here.
I don't disagree with all the panelists said. I don't think the LPs are different in terms of GP selection criteria. Globally, we prefer proprietary deal flow, operational value add. It's almost a cliche. I think what's different in Asia, for all these years we've been here, a couple of things. The market evolved very quickly. And we believe at the times, 4 or 5 years ago, wasn't the right time because the user base has been pretty low. But right now, this year, is actually a good time to actually consider VC investment because we are at the inflection point where things could be very interesting. So we recently made a VC investment based on that thesis. So I think in short, we have the set criteria which is universally applicable. And in the meantime, we're looking for specific characteristics to the Indian or China market to be slightly ahead of the curve. I agree with what Vikram has said. People is the most important thing. And we do spend a lot of time and efforts on people diligence. We usually don't back first-time fund because we don't know those people that well. We've been Asian long enough to know that things can go wrong very quickly. So you have to understand who you're dealing with. And at the time when it goes wrong, you have to be able to sit down with the people and talk to them. And because we are here, we have nowhere to go. We have to pick up the pieces, so to speak. And the other thing that we do, it's slightly different from even within our own group in Asia, is that we do a lot of company interviews. Because this is the only way you can understand what the GP has been doing. There's a lot of talks, all the Indian GP are very articulate, but in the end you have to understand what they've been doing. I think there's no better way to replace the diligence on the companies.
That's really interesting. So just a really quick follow-on to what Vincent said. Do either of you engage in the interviews of the investee companies and the managers that you're looking at?
GP friendly than some of the responses that we've gotten about GP involvement from the companies in India. And so you've got to basically ask the question differently. You've got to get an understanding of what happened before from the GP, make sure that it's consistent, and then get prepared for some of the responses that you get over here, which is, we don't even know who they are, and yes, they gave us money, and the money was great. And you then need to sort of decide if you want to sort of keep probing further, because at the end of the day, that was a successful investment. Does it matter that the owner didn't care? It was just money coming in. So the GP at the end of the day made great money, right? It was a 5% minority stake that they made 5 times their money on, versus somebody else who's 30%, and then the entrepreneur clearly knows them much better. So there are certainly cases where we've made calls where the entrepreneur, the owner, doesn't necessarily even know the person, and says, yeah, when the banker went out and marketed, we met 30 people. The banker decided who was going to get the money. At the end of the day, was Valuation that brought the money in, and 2 years later we sold the company, or we listed it, and we don't hear from them again.
Yeah, no, I think everybody goes through the same process of talking to the fund. I think it is interesting because you do hear some much more blunt responses here than you would in other markets. So sometimes it's when people are spending years together on a board and the dynamics exist, it's either they'll give you the blunt feedback on sort of how they feel about the people that they've worked with, or you can just see it in their response or the way that they say it or their face, and even if they're trying to say something nice, you kind of know the answer just by the body language. So it's a huge part of it. I mean, we all have to do it.
And then balancing, finding those opportunities, getting ahead of the curve, with staying with the manager too long.
This is something we do searching on all the time. It's not an easy decision. I mean, the GP has been working well for you for all these years, and all of a sudden there is a bigger fund, you cut them off. But we do make those kind of decisions, not because we like or dislike the fact that we raised too much fund. I think it's more important to see that where the opportunity sets fit what the fund size the people are raising. What I mean is, if you look at China-India average deal size based on a lot of research, is about maybe 30 to 40 in China, 10 to 20 in India. If you talk about 20 fund companies in the portfolio, you're talking about maybe $200-400 million for India, which is sort of the right size, and maybe $500-600 million for China. So we decided not to re-up, despite the fact the fund was oversubscribed, and many of our peer groups went in for the first time. So I think those kind of decisions, as an LP, we have to make tough decisions all the time.
Yeah, I think you break it down to two. So the funds that get much larger, I think, they're just different. So I think everybody understands that if they change the size and the sector that they're going after, the LPs might have a different mindset as to whether or not that's the right segment. And I think it comes through communication and spending time that, if it's not the right strategy, you sort of give the person that feedback early on so they know not to count on you in the next fundraise. I think there's a bias if somebody's done well for you in one fund and they've changed or gotten bigger in the next fund, you're likely to give them a little bit of leeway, obviously, and then if that fund doesn't work out, then you basically are, you're out, and I think for the right reasons, everybody understands it's an economic decision. I think on the ones that become much more tricky are the first-time funds that you work with, or the niche strategies or opportunistic strategies where you're investing, you might know going in that it's only a one-time thing, or if it's a first-time fund, you're going to work together on trying to develop it. So in those dynamics, it's very important to sort of at the front to kind of explain, here's what I think you need to do for me to be a part of the next fund, or if things aren't going right, or if you don't think the communication is proper, or not enough transparency, or you're not getting the right story. It's a consistent process, and you're also coaching on what the fundraising might look like in the next go-round, because if you're on the advisory committee in a first-time fund and then you don't commit in the first close to the second fund, it's very hard for that fund to obviously go out and fundraise. So it's a very touchy dynamic. So in some cases we actually opt not to be a part of an advisory committee because we don't want that conflict to sort of skew what the next view will be.
Yeah, on the first-time fund issue, we are relatively agnostic to that. We're willing to take the risk if we think we're going to get the returns that the team justifies, and if that's the best team in the market, we are fine with a first-time fund. In terms of going with an established manager, the re-up process, etc. Again, it's a merit-based decision. There's no automatic re-ups, and if the manager is still performing, and we think with the new fund size, whatever that is, the manager will perform relative to everybody else in the market, including first-time funds, then we'll go with that re-up as well. So I do think the bias, at least from our standpoint, with India, largely because of fund size more than anything else, and the space that first-time managers are likely to be playing in, just given it's a tougher fundraising environment, and I think they're going to end up with smaller funds at the end of the day. I do think that at least this year or next year, it'll be more likely that we do more first-time managers than the bigger funds in the near term.
Great. We'll just take a pause there. We've got, I think, probably about 15 minutes left in our panel. I wanted to see if there were any questions from the audience. I see Samir, and I can't see who else that is. We've got a couple questions towards the front.
Samir Narula, August Capital Partners. Just a question in terms of the size of a fund that you would go into. So given that the market's changing, and Vikram mentioned first-time funds, would you invest in funds that are smaller than $50 million in the venture capital space?
That's 15?
50.
50.
Yeah, I mean, we're actively looking at a few that are smaller because we think that it's, again, when we look at some of the funds that we perhaps passed on in the last go-round that were sub 50 million, we have one commitment to a sub $50 million fund currently in India, but when we look at the ones that we passed upon, the returns are phenomenal because they had a very niche strategy. They went after certain deals. They weren't forced into going after certain things. So it was a very, I think it's a strategy that works. I mean, again, you have issues on, is it a sustainable platform as time goes on? But again, that's where you have this discussion about what the long-term aspirations are. Is it something that's just sort of a finite period that this is the opportunity, or is it really going to be, 3 people with a sub $50 million fund doing the same thing over and over again over the next, 3 or 4 different funds they raise? So
we're probably slightly different. We're looking for a better, sort of, not better, but more risk-adjusted returns. So especially for the Indian market, I don't think we have that. Maybe if this is for China, we can consider it, but for India, probably not.
What are the best practices you've seen in other climates that might help first-time GPs here think through a much more sophisticated and robust strategy in operational execution?
I don't think there's a standard answer. Even the most established funds with operational platform are still experimenting in India. So I think having operational capability is definitely than not having that. But how you work with entrepreneur, what's the right balance, how much involved you want to be with the companies is really team specific. As long as it works, that would be great.
Let's talk about the risks of investing through private equity in India versus other markets where you're doing PE.
So I think the fundamental difference, and it shows in all the numbers, is the exit volume and the exit numbers actually happening a lot sooner in other markets because they can control the timing. So that's one big dynamic that exists here. And everything takes a lot longer here, it seems, and obviously there's a lot of hurdles, whether it's, if you're building something out, getting the right approvals, it's always 1 year out. You're investing in a lot of cases off of a forward multiple, so there's a lot of, obviously the ratchets and everything in place, but the numbers that you expected to get into weren't necessarily the same numbers because certain approvals didn't come through. So I think the regulatory environment and the bureaucracy is obviously a very big deal here, particularly when you have no ability as a minority investor to really influence the changes there. So I think that's, one fundamental.
All right, well, I guess you can sense, I'm not going to ask the panelists to tell us if it's India, China, or none of the above. You'll have to track them down after this panel for that. But you do get the sense that we collectively reject the question that the approach in India is just by necessity different, and it requires being highly selective in who you partner with, not only managers but also investee companies, to really find the opportunities and to structure them to your advantage. So with that, we'll close for now. Thank you very much for your attention. Please join me in thanking our panel.